The pros and cons of fractional reserve banking, implications for the stability of the international banking system. Fractional reserve banking is a system where commercial banks are required to hold only a fraction of the deposits they receive from their customers. This fraction is known as the reserve requirement, and it is set by the central bank of a country. The remaining funds are then lent out to borrowers at a higher interest rate, generating income for the banks. While this system has been in place for many years and is widely used in modern economies, it has been the subject of controversy and debate due to its implications for the stability of the international banking system. One of the main concerns with fractional reserve banking is the risk of bank runs. A bank run occurs when a large number of customers attempt to withdraw their funds at the same time, leading to a liquidity crisis for the bank. In a fractional reserve system, banks do not have enough reserves to cover all of their deposit liabilities, so a bank run can quickly lead to insolvency and potentially trigger a wider financial crisis. To mitigate this risk, central banks often act as lenders of last resort, providing emergency funding to banks in times of crisis. However, this can create a moral hazard problem, as banks may take on excessive risk knowing that they will be bailed out if they get into trouble. Another concern with fractional reserve banking is its potential to create inflation. When banks lend out the money they receive from deposits, they increase the money supply in the economy. This can lead to inflation if the increased supply of money is not met with an equivalent increase in goods and services. In addition, fractional reserve banking can contribute to financial instability and systemic risk. Banks are highly interconnected, and a failure of one bank can quickly spread to other banks and financial institutions, creating a domino effect that can lead to a wider crisis. Despite these risks, fractional reserve banking remains the dominant system used by most modern economies. Proponents of the system argue that it allows for greater access to credit, promotes economic growth, and provides a mechanism for banks to earn a profit on their operations. However, it is important for regulators to closely monitor the activities of banks and ensure that they are operating in a responsible and sustainable manner. This includes setting appropriate reserve requirements, conducting regular stress tests, and enforcing strict capital adequacy standards. In conclusion, fractional reserve banking has both benefits and risks, and its implications for the stability of the international banking system are complex and multifaceted. While the system has proven to be effective in promoting economic growth and providing access to credit, it also poses significant risks to financial stability and requires careful monitoring and regulation to ensure its continued success. Thanks for watching.